Morning, everyone. Is it coming through loud and clear? I know we've had some technical difficulties this morning. I just want to say well done to AFSIC for having the ESG panel in the morning of the first day. I think it's traditionally the graveyard shift at the end of the conferences. So that's a bit of a change. I hope we don't see that the attendance in the room is indicative of interest in South Africa. Who's from South Africa in the room? So just you guys can hold me to account here, but yeah, thank you. Okay, so hopefully there are more people who are interested in our country out there. They just can't make the session this morning. But I just want to, I've got 15 minutes, make a few points around investing in South Africa. I know that it's, the South Africa investment slot is often a slightly different one in Africa conferences. A lot of the focus is on the rest of the continent. And South Africa tends to sit somewhat apart in a lot of the conversation. So I just want to make a few points around this. For those of you who don't know 27.4, we're really an intermediary mainly between the South African institutional space, so the domestic savings pools. So we mainly work for South African pension funds and help them with their private markets investments. So that means we act as fund of funds managers. We invest directly into companies, and in certain instances we even just act as advisors. So we really just whatever is needed from the institutional side to help them to get exposure into the private markets. That's really what we do for them. I'm going to try to get my slides to move on. Not moving. So because we're mainly talking to South African institutions, we often don't have to make the case about investing in South Africa. So mostly that's a given for our client base. For those of you who are familiar with the pension fund rules in South Africa, there's a big onus on domestic investment, and so for retirement funds who want to get exposure to the real South African economy, they invest locally and through the private markets investments. So we often don't have to deal with a lot of the negative news flow that's out of here. So in preparation for this event, I just had a look at the BBC to see what actually came up when I looked at the South African news stream, and I must say it was pretty bad to see what actually makes the news in the UK and on BBC about South Africa. And for those of us who live there, we know that these things are news. They are the real news, but there's obviously a lot more to it. And so, very little actually kind of makes it through. But, I think there's no getting away from the fact that we have a lot of issues domestically. There's, everything you see up on the slide, we've had issues with floods, shortages of various things. There's been natural disasters, things that are kind of part of the climate change issues also affect South Africa in a big way. We've had the heat waves. Like I say, we've had the floods, and very recently, actually 10 days ago or 2 weeks ago rather, where I live in Cape Town, we've had the worst floods in decades, and actually washed away bridges that have been standing for 50 years. It was a serious disaster. So there's a lot of challenges that we have. But I guess my message here is that there's a way to invest that actually gets you past those issues. The other thing that's come up a lot, and for anyone who follows South Africa will know, this is Julius Malema, a populist in South Africa. My my father actually lives here in the UK, and whenever Julius Malema pops up on the BBC or on CNN or something like that, which he does from time to time, I get a call to hear that the country is falling apart and that this is the leadership. But of course, this is not the leadership. This is a fringe party. It's the fringe party in South Africa. I like to tell him, that's equivalent of just looking at the UKIP in the UK and saying that this is what's happening. But of course, it's a fringe view. And obviously, it's the party that's struggling to get past 10% in the polls. So although there's a lot of negativity there, it's not really what's happening. I'm almost past the doom and gloom part, by the way. So there's the biggest issue that we've been struggling with over the last few decades has really been our lack of electricity supply. And this is something, for all of you who work all over the continent, this is an issue across Africa. Most African countries struggle with electricity supply. In South Africa, this is something that's worsened over the past 15 years. It's been a constant battle, and this year really is when things have really come to a head, and there have been a lot of efforts, and finally a whole lot of money being invested to alleviate this issue. But it's a real issue, and it's put a real constraint on economic growth. I think what we find interesting is the extent to which South African companies can cope with this sort of thing. If you think about what it's really meant in practice, and I think some of you live in South Africa, some of you don't. But for those of you who don't, we started this year with what we call load shedding. It's sessions of power outages, and from the start of this year, we had a really bad patch of where power would go out for up to sort of 8, 10, even 12 hours a day. Businesses have managed to cope, and a lot of businesses have actually put in enough of their own generation to help them to cope with this issue. And this is kind of one of the factors. Although it's an extremely negative factor, what's really interesting from our point of view is just how well the economy has actually coped with it, how resilient it's been. And we've not seen negative growth. We've actually seen positive real growth through a year where you've taken out a whole lot of electricity supply in the market, which is actually quite a remarkable fact. And you've seen the private sector really come to the party to actually create its own generation and get past this issue. So we've got all these problems. There's a whole lot of kind of issues that South African companies are dealing with, but there's still a very resilient and quite vibrant business community and economy in the country. So this chart is showing how the enterprises in South Africa actually break down. This comes from tax records, so it's pretty resilient data. It's from a couple of years ago, so it'll be representative. What it's actually showing is that there's around 2 million different business enterprises in South Africa. Of course, most of them are very small, but we look at this to see what is the investable universe in the country. And from our perspective, there's at least 10,000 companies that are investable from a private markets point of view just in South Africa. So mainly where these companies are sitting, they're in the mid-market. So the majority of investable opportunities are really in the mid-market. So they're sitting below the listed markets. They're not SMEs. They are companies that are mid-sized. They operate in niches in their particular sectors and are pretty resilient. And I think what's also interesting to us about this is although there's 10,000 companies to invest in, but what we find interesting is that these companies typically operate at higher margins than their peers in other markets, and part of this is because of what I've been focusing on today so far. The lack of or the difficult operating environment actually makes it less attractive for international enterprises to come into the market. So what you see is that you see companies being able to actually sustain their margins better than in other parts of the world. The other factor that's really interesting to us is just around the multiples. So, this is something, I've personally tracked very closely over the last 15 years to see how deal pricing in private markets has moved over the continent and particularly in South Africa. In South Africa, since, there was a bit of an uptick in deal multiples around the time of just prior to the financial crisis. There was quite a lot of optimism that the global private equity model would work well in South Africa. I think that didn't really work. But at the time, some of the deal pricing went up with it, and probably the most infamous case of that is the Edcon deal that was done in around 2005, which didn't end well for a lot of the investors. But since then, since the multiples fell back down again post the financial crisis, we haven't really seen a recovery in deal multiples since that point. Whereas in global private markets, you've seen a huge acceleration, as you see on the chart. You've got the US and European markets really having one-way traffic, as we saw, a decade long, or more than a decade long, of low interest rates that pushed up deal multiples across the world. We didn't see that in South Africa. We never saw that recovery actually happen. And that leaves the situation where, across most of this period, and certainly today, you see, every deal that we see, and like I said, we invest through fund of funds and directly ourselves, so we see a lot of deals. Everything we see really sits between the 4 and 6 times EBITDA in the private market space, and similarly in the venture space where we also invest. Multiples are lower than they are in the global markets. All of this means that there's a real opportunity. It doesn't mean there's a macro opportunity. You cannot invest in South Africa and expect a rising tide just to pull up your investments. We don't like the argument of demographic shifts, of urbanizations, of all of that. It's very difficult to actually invest in those things. They may be long-term themes, but in my mind, they don't really fit a private equity investing cycle. You can't bet that urbanization is going to work in your 5-year cycle in your private equity fund, and that the demographic dividend, all of these African people are going to come through in your investment period. That's an interesting long-term theme to keep track of, but it's very difficult to invest behind. We think the opportunities are much more micro than that, is to look inside the sectors, see where you've got really good operators in sectors, and where there's particular advantages that protect that space, and there are those opportunities. And my last slide is just to show some of these, and I'm looking around the room and I see some other people who are actually involved in some of these opportunities. These are just a few things that have come up in both our venture portfolios, our fund of funds portfolios, and our direct investment portfolios over the last, I think all of these have come in the last 2 years. But the couple of themes that I just wanted to pull out is just mostly it's about resilience. It's about companies that don't need a whole lot to be successful. They just need things to continue. You can see some of the sectors that I've pulled out, themes that we've invested behind, which are really around things that there's not really much of a growth factor built in to any of these, and to most of these investment themes. Or rather, there may be a growth factor with the individual company if they've got a particular, particularly where we're investing at the early stage, but we're not looking for growth in the particular sector or in the economy that we're investing behind. We're looking for things that have inherent demand that don't require any big shifts to happen, and we think this is where you're much more likely to have success in investing behind something that almost needs very little to go right. Things just need to kind of continue. Things need to continue on, and you can make your returns by investing at the right price and investing with the right sort of management, investing behind the right teams, and with the right levels of the right structure. One thing that we've seen go wrong quite badly over time is over leverage. This is something we avoid. like the plague, but we don't see that it's an issue in these particular deals. Okay, just a last point. I'm getting the double ding on the bell now. So I think what's interesting to note, a lot of people write off South Africa and think that that there's too much negative, too many things that are going wrong. But I think what we would argue is that the returns on our main funds, we're sitting at a net return of 17%. That's something that's been in place over the last 6 years, so since inception, over one of the most difficult periods in our country's history, through COVID times. That's something that you can't argue with. It is possible to achieve these returns if you're investing in a very thoughtful way. But equally on the impact side, I know DFIs have classified South Africa as middle income, and as if we don't have a whole lot of the social challenges that we actually do have. We've got 37% unemployment. Young people don't have jobs. We have serious social problems. There's real opportunity to create jobs through this kind of investing and to really change the way that South Africa operates. So we think there's huge opportunity both for returns and for impact. And I hope that many of you see the same thing. Thank you, and have a good day at the conference.
Many thanks, Rory. And if you'd like to ask Rory any questions, he's here at the front. Do find him in the break, and I'm sure he'll be happy to answer questions. Brilliant. Well, now we're moving on to our next panel session. We're slightly over time, but we'll make sure we